Hi, I'm Christine Benz from Morningstar.com. Mutual funds have been losing assets at the expense of exchange-traded funds. Joining me to discuss that trend is Russ Kinnel. He's Director of Manager Research for Morningstar. Russ, thank you so much for being here.
Glad to be here.
You discussed this phenomenon in the most recent issue of Morningstar Fund Investor. You say that there's obviously something going on in the world of actively managed mutual funds. Let's talk about this trend where we've seen investors swapping actively managed funds, in particular for ETFs. Can you quantify that for us?
Yeah, we're really seeing an unprecedented level of outflows at actively managed funds. I was looking at the Morningstar 500 and found that 17 of the 500 had outflows of more than 50% in the trailing 12 months.
So the 500, those are generally some of the biggest funds out there,
biggest,
right?
best, and well-known names. And another 80 of those 500 had outflows of at least 25%. So really dramatic level of outflows from a wide swath of funds.
And you pointed out in your article that this is remarkable given that we've come off a period of relatively strong performance, so investors don't seem to be necessarily responding to losses in those funds. It's really that consumer preferences are shifting and investors are increasingly gravitating to ETFs.
That's right. The market's had a bit of a downtick, but compared to previous bear markets where you might say lose 40 or 50% of your value, at times like that, the outflows are understandable. But really, these were already underway before even the last few months of sell-off. And so really, it is unprecedented. You see people are being less patient with an underperformer and sometimes even selling funds that are performing pretty well.
And you point out this isn't entirely bad, that overall the trend toward ETFs has pushed down expense ratios throughout the asset management industry, so that's a plus. And you've also talked about how some good quality funds have reopened for the first time. But let's talk about what investors should be thinking about as they evaluate outflows at various funds, and you brought some specific funds that you think are good illustrations. Let's start with kind of the poster child of when outflows can be a problem, and it's that Third Avenue focused credit fund that imploded back in 2015.
That's right. When you think about outflows, the biggest impact you want to look at first is liquidity issues. So are the outflows making the managers sell their holdings at a loss, because you can have a negative spiral where they take more losses because of selling and because of outflows, and then they have to sell some more, and it has this really negative spiral. We've seen that a few years in the history of funds, and the Third Avenue was an extreme case because they had to more or less prevent any more redemptions, or going in for that matter, because they had some really illiquid, low-quality bonds, many of whom were either near default or in default, and so they called a halt. They tried to kind of shut the fund down completely, but instead they kind of are in this unusual state where no one can get in or out. They're making periodic disbursements, and the point of doing that is to enable them to gradually sell. But that is, as you say, the worst case scenario. Very, very few funds are likely to find themselves in that position, but it is a good example of one of the things you worry about most when you see redemptions.
PIMCO total return, I think, is a good counterpoint to that Third Avenue situation in that it too had very sizable redemptions, certainly in dollar terms, maybe not as a percentage of its assets, but its redemptions were sizable, and yet it seems to have managed through them.
That's right. In dollar terms, it was just unprecedented by an order of magnitude and really unusual to see. And yet PIMCO Total Return, which invests almost primarily in high-quality bonds, lots of derivatives, and had been building cash even before Bill Gross's departure because it was already in outflows, it's handled redemptions very well. You can see that by looking at the total returns. You can see it's performed pretty well. We've modeled it to see, how would we expect performance if there were no outflows? And it's been very tight on that model, which suggests that outflows have had a very small impact. So that's a helpful guide right there for bond funds, is if it's a high-quality bond fund, probably not a big deal if it's got big outflows or even big inflows for the most part. And as you move lower and lower in quality, there can be less liquidity. If you have more focused portfolio, that was another issue with Third Avenue, was that it had a lot of concentration. Typically, junk bond funds do not have a lot of concentration, partly for that reason.
Let's discuss some of the equity funds that have seen outflows. You looked in your fund investor cover story at funds that saw big outflows as a percentage of their assets. So Manning and Napier equity was at the top of the list in terms of those percentage outflows. Let's talk about the situation there.
Right. So Manning and Napier is a shop we like, but they got energy wrong, and it's really hurt their performance in their funds a number of years, in recent years. And we're seeing that reflected in the outflows at this fund and a number of their other ones. The good news here is I don't think it's going to have a big impact on returns in the near term, because Manning and Napier equity is a large cap focused fund, and because it wasn't that big a fund to begin with, so it would take a lot of dollars to impact large cap stocks. So I don't see a short-term impact. Longer term, we're certainly going to want to watch the firm, because there can be some negative impacts on the firm itself from that. For instance, occasionally you'll see layoffs or other things,
People quitting or whatever.
Right. It can be demoralizing as well. So we're a little early stages for that to be a concern, but it's something you want to watch.
Okay. Another equity fund that appeared high on your list was Buffalo Small Cap in terms of having big percentage of assets outflows. Let's talk about that one. It seems like you're a little less favorably disposed toward that one.
That's right. So in equities, it really goes large to small. So I worry much more about outflows in a small cap fund like Buffalo Small Cap, because there's less liquidity, and you really can have that feedback loop of flows and performance. On top of that, there's been manager turnover at the firm. So there's a number of warning signs there, which is why we've got it rated neutral.
One other thing that you say that people should keep an eye on is whether outflows could force changes at an operational level. So I'd like to take a closer look at a couple of artisan funds that have recently announced that there will be a merger. Let's talk about that and how you think that can be reflective of some issues that can go on when there are big redemptions in funds.
That's right. Their value team has had a rough go of it the last couple of years after having a really great run. And so they have a large cap, mid cap, and small cap fund. All of them are in redemptions. And they just recently announced that they're going to merge the small cap fund into the mid cap fund. And that's another thing that can happen when you have redemptions, is you can have a fund merged away, even though it's still got a pretty good team there. Now something different is happening. So if you bought that fund for small cap exposure, obviously you're not going to maintain that small cap exposure.
Okay. So in terms of broad takeaways, first, can you give viewers a little coaching on how do they keep track of asset flows in and out of their funds? What's the best way to do that?
Well, on Morningstar.com, you can pull up a one-page PDF and see year-on-year assets, so you can look for significant changes in that. You can obviously also look for that in the shareholder report as well. And of course, in our analyst reports, if we think flows are a significant issue, our analysts are going to highlight that. And there have been a number of funds where flows are a big enough concern that that's been a part of why we've lowered a fund's rating. So there are a few different ways to get a handle on what the flow situation is.
And just to review some of the commonalities among situations that would be most concerning, it would be if the fund traffics in less liquid securities, so maybe it's a small and mid-cap product. Any other types of products where I should be more concerned about big outflows?
Certainly high yield, and I think beyond that, a focused portfolio, occasionally that can be an issue. Also look for taxes, because we have the unusual situation where we've had a nice stock rally and we have redemptions. So what that can mean is if there's a big tax overhang in the portfolio, they have to sell to meet those redemptions, and then they're going to pay out a cap gains distribution among the smaller pool of shareholders. So you might have a big tax distribution going in. If you're thinking about being contrarian and buying one of these funds and outflows, at least check that potential cap gains exposure, which is on the tax tab of Morningstar.com.
Or maybe do it in your IRA versus...
Right, or in your IRA where it's not an issue.
Okay. Russ, thank you so much for being here to discuss this issue.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.